All right, good morning, everyone. This is Robert Kernan, Managing Director at the North Star Advisory Group. This morning I have with me Michael Rosen, Chief Investment Officer and Managing Director, Jeff Silverman, one of our financial advisors, and Sloan Spiewak. She is one of our internships, and today she's going to play the role of moderator. Today we're going to speak about the recently passed legislation in regards to the new tax rules. And Sloan, you want to kick it off?
Yeah. So I think we can start with the SALT deduction with Robert. So what is the SALT deduction?
The SALT deduction is the state and local tax deduction. It allows taxpayers who itemize their taxes to take certain deductions in regards to property tax and state and local income tax. Uh, this new limit, which prior to this legislation was $10,000, is now $40,000. So people that are in high tax states such as New York and New Jersey may stand to benefit from this new legislation. It is temporarily increased to 40,000 and will decrease back to 10,000 in 2030 under the current just passed legislation. However, you must itemize your deductions to take advantage of this on your federal tax return. And the other key point to be aware of here is if your income is over $500,000, you will start to lose the ability to take the SALT deduction. However, it will not go below $10,000.
Okay, we can move on to Social Security deductions. Let's go to Michael with that one. What is the Social Security deduction for Americans 65 and older?
So the first thing I would basically say as it relates to this um, is it is a deduction. It does not mean that Social Security tax, which originally people thought was going to go to zero and seniors were going to be paying zero tax on this. It is a $6,000 deduction for a single filer and a $12,000 deduction for a joint filer. Um, they do not need to itemize. So this year, if you are a joint filer, let's say, you can your standard deduction is $30,000. If you're over the age of 65, you get an extra $1,600 per participant. So your total deduction would be 33,200. So this additional money would be again 6,000 for single, 12,000 for joint, would kick you up to basically somewhere close to $45,000 in deductions for seniors. The only other thing I would kind of bring to light is there is an income requirement as it relates to this. Your adjusted gross income for a single filer has got to be $75,000 or less. And if it's joint, it's basically $150,000 or less. You will get some of the deduction if you make more than those thresholds, but it'll basically start to phase down as far as how much you'll actually be able to benefit.
Mhm.
So Michael, in regards to that, what I think our clients should do, especially as we approach year end, is they should have a conversation with their accountant or tax professional and say, hey, look, I'm taking distributions out of my IRA. Am I close to this limit? Because if they are, they may want to try to delay, especially if it's November, December, their final distributions to keep them below the limit to take advantage of the tax deduction.
Correct. And this is something that's going to expire at the end of 2028. So to your point, they should basically be thinking about how can they sort of benefit from the system for just basically this 4-year period, 2025 through 2028, in talking to their accountant and thinking about what their expenses and cash flow and needs are basically going to be, and anything that they can do to help kind of minimize that adjusted gross income.
Right. And Jeff, you know this and you know this too, Michael, just because we tell clients they can take a certain percentage out of their IRAs, obviously as long as they meet the RMD requirement if they're subject to it. But, they may not need that money. All right. They may take and stick at their bank account. So if they're doing that, maybe they just hold it back, to your point, Michael, to take advantage of this new tax credit.
Agree.
Yeah, it also looks like one of the other provisions of this new tax rules are auto loan interest. So how much interest on auto loans can I write off?
So you can write up to $10,000 a year in interest on auto loans as long as the car is brand new and made in the United States. I don't know if it's, I know it's complicated because a lot of the parts can be made in other places, but I think, and we'll find out more. And this goes to a lot of what we're talking about today. All the information is not out there, but we're putting out, we want to give you high level information right now. If the car is manufactured in the US and it's new, you can write off up to $10,000 in auto loan interest. And that's pretty huge for almost all of us out there.
Now that car has to be what, for personal use? They can't be deducting it through a business, correct?
Correct. It's for personal purposes.
Do you have to itemize to claim the deduction?
You do not have to itemize for that.
Okay.
And then is there income restrictions on this, Jeff?
There are $100,000 for individual filers and $200,000 for those filing jointly.
Great.
Okay. Is there a start and end date to the deduction?
There is Sloan. It applies to vehicles purchased between 2025 and 2028.
Okay. With these new laws, there's also an estate tax deduction. So let's move on to Robert with that. So what is the change in estate and gift tax exemption?
Okay, in regards to the exemption, right now it is 10 million per person. What's going to happen is that's going to increase to 20 million, and then per married couple, it's going to go from 15 million to 30 million. So essentially doubling. All right. A lot of clients aren't going to fall into this kind of number, but what clients need to consider, especially if they're gifting on a proactive basis to their children, grandchildren, great-grandchildren, is the gift tax exclusion is going to go up to $18,000 per person. So what that means is anybody can gift anybody else. They don't have to be related. $19,000. No questions asked. The person gifting the money does not have to report it on their tax return, and the person receiving the money does not have to report it on their tax return. This is called the gift tax exemption. And what happens is what we recommend clients do, and I'll give you an example. I just had a husband and wife. They're starting a very aggressive gifting program to their 3 daughters. I have them each write their own check, 19,000 and 19,000 to each of their daughters. This way, if they were to get audited, they can justify to the IRS, hey, we each gave each of our daughters $19,000. All right. So between a husband and wife, that's a total of $38,000 that they could give to each of their daughters every year. All right. So they've come to a point in their financial lives where they realize they're never going to outlive their assets. And we had a conversation. And I always say to clients, and I will always say, it's always easier to give money away while you're still alive. This new law makes it easier to do that and increases the limits.
Yeah, I would
So
just jump in and clarify though, it's a 50% increase, not a 100% increase, Robert. So it's 10 million going to 15 million single, joint goes from 20 to 30 million dollars basically.
Yes.
And if it didn't happen, which I think a lot of people were concerned about from an estate planning perspective, it would drop basically from the $10 million as to where we are down to about $7 million at this point.
Yes. Thank you for the clarification, Michael.
Yeah, no problem. That's why we're all here. We got a whole team.
And the gift tax exclusion is 19,000 per recipient per year, not the 18,000.
Yes, correct. It's currently 18. It's going up to 19.
It's 19.
Okay. One of the other new things that's out there now are child savings accounts. So let's go to Jeff with that one.
All right, this one I think is really exciting. I've been kind of watching it to see and hoping that it would come to fruition, and it looks like it has. So the federal government is going to give every child born after December 31st, 2024, so last year, $1,000 to open a brokerage account that they can invest in an index fund such as the S&P 500 fund or something like that. And you can hold that account with pretty much any brokerage, I believe. For instance, if you're a counselor with us, you could hold it with Schwab. And this is a great way to get everyone involved in the U.S. stock market. And I was just playing around with it. Like, for instance, if you take that $1,000 and put, say, $750 a year and invest that in a typical fund earning 8-9%, you could have $50,000 at age 18. And they're able to draw the funds at age 18 for qualified purposes, such as college, to start a business, um, to buy your first home, or you can draw it at age 25 for any purpose. And then parents, grandparents, anyone can give up to $5,000 per year into this account.
Now, this one, Jeff, I think out of all the new changes, this one still requires a lot of clarification as to execution, how to take advantage of it.
Yeah, they haven't really clarified how to open the accounts yet, but that should be coming soon. So once we have that information, we will definitely pass that on because we think this is really a valuable tool for parents, grandparents, aunts, uncles to help anyone who's having a baby. I mean, that's 4 years.
And I would jump in and just say that there are a lot of corporations that have made comments in being in supportive of this, right? So they're able to take $2,500 tax deductions in making contributions for this. So I tell you, if you're having a child or grandchild, you should really check with the employer and basically see who's willing to match these funds, because from our due diligence and just all the companies that we follow, I would say there are a lot of them out there that basically are very supportive of this, and I think you're probably going to see more and more of that out there.
Great.
I just want to clarify, at age 25, they'll have full access to the amount, but only for qualified purposes, like for college, starting a business, buying a home. But to have full access for any purpose, you have to wait till you're 30.
Oh, okay. Thank you for clarifying.
Okay. There's also been updates to 529s. So I think we can go to Michael with that one. So how are 529 plans impacted by the bill?
So just so everyone understands, 529 plans are typically what people use to put away money for a child for higher education, right? For mostly college or schooling or trade schools or so on and so forth. I can be used for grad school. Some people even use them for wealth transfers as a great way from an estate planning perspective. So in this new bill, one of the changes that basically took place was the ability to withdraw. Instead of withdrawing $10,000 for grade school education, you can withdraw $20,000 basically a year for that grade school or even homeschooling. And you can do it for any other second tier type programs, as I mentioned, like apprenticeships or any certification type program or trade school. Within this act, I mean, I think as we talk to many of our clients about, saving for a child or a grandchild, because college costs are going up so much. One of the things I think that's also highlighted within this bill is just student lending in general. And one of the things that the government is trying to do, because we have these ridiculous deficits and what have you, is the government is basically trying to push families away from basically borrowing from the government. So they're putting a lot more restrictions on there, and they're trying to push families more towards private lenders like banks and other financial institutions instead of getting regular loans directly. And I think part of this methodology too is because the cost of tuitions in universities has continued to skyrocket in this country over the last couple of decades. So by pulling back on some of the government funding, we'll also start to kind of reduce some of the inflation that we've seen in college tuitions. So just a couple of things I think to highlight. Again, we do a lot of the 529s at Schwab's. We have clients that use those or use any other states. We're more than happy to kind of help educate you on how these plans can be helpful for your family.
Yeah. And the bill's also updated the child tax credit rules. So we can go to Robert with that one. So what is the child tax credit and who's eligible?
So the child tax credit is designed to help parents offset the cost of raising their children. So if you have a child under the age of 17 with the new bill, you can get up to a $2,200 per child credit taken off your tax liability. Now, you need to be aware, again, like everything else in this bill, there are some income thresholds that if you cross over, you will not receive the full credit. So if you're single and earn under $200,000 adjusted gross income, you will receive the credit. If you're married, filing jointly, or just filing as a joint couple, again, under $4,000 is where you'll receive the full credit. Now, if you are over those income thresholds, the credit will gradually phase out. For every $1,000 over the limit, your credit is reduced by $50. Now, these benefits, all right, are going to be subject to potential change. And if there are people who are dependent who are not children, this new bill will make permanent the $500 non-refundable credit for other dependents, i.e. aging parents or adult children with disabilities.
Okay. Does anyone have anything to add about that, or does that cover it?
No, I think a lot of families are going to benefit from the additional dollars. I mean, there are some income limits on that, but I definitely think that, it's something that's basically going to be beneficial to many households. And I don't think, Robert, did you comment on the fact you need to itemize to basically benefit from the child tax credit or not?
No, fortunately, you do not.
Okay. Let's move on to the employer provided child care credit. So it looks like that's increased with the new bill. So let's ask Jeff about that one. How has the bill changed employer provided child care credit?
Okay, so it's up to $500,000 a year. So if you own a business and you provide child care for your employees, you can now deduct up to $500,000 per year of that cost.
Okay. Does this rate change for small businesses? Can they do more or less?
Actually, for small businesses, it's up to $600,000.
Okay.
So again, I mean, one of the strategies here and thinking about all the other points of this new tax legislation, there's a way for a business owner to possibly shelter some of their income to stay below certain limits to take full advantage of all the other credits that this bill is going to make available. Again, they have to discuss this in conjunction with their accountant, but we're happy to, to strategize with the business owner and their accountant to help them achieve these objectives.
Yeah. Lastly, let's move on to tips and overtime. So there's been some talk about no tax on tips and no tax on overtime, which isn't completely true. So let's just dive into the weeds a little bit. So, Michael, can I receive a tax deduction for tips?
You can, Sloan. You can actually receive up to $25,000 deduction on any tips if you're filing singly, or up to $50,000 in joint, right? Which is interesting on the $50,000 joint, because it basically says, hey, if me and my wife, if one of us work in a job that basically allows tips, and let's say my wife basically has the ability to deduct $45,000, because again, we're sort of in that joint. So it's not like it's capped at the $25,000 for each of us. It's again at that joint at the $50,000. And again, this will happen between years 2025 and 2028. That same 4-year gap that it seems like this bill is heavily focused on. Again, there is an income level that you should be aware of. Again, we're back to the adjusted gross income, $150,000 basically for single filers, or $300,000 for joint. Now, the thing I would point out is, you can't go to your employer and all of a sudden ask them that you want to start working for tips. So within the bill, everything like that, it basically has to be.
Tips.
Which say you want to start getting paid?
Come to you.
Oh, there you go. So basically, within the bill, you can only basically get this deduction for occupations that typically were getting tips beforehand, prior to December 31st of 2024. Otherwise, you really wouldn't qualify. It's a lot of service sector oriented type stuff. Let me jump in on the overtime too. A lot of the same type of stuff, a little bit different numbers. $12,500 deduction for a single filer as far as deduction. So think about that. That's almost about $1,000 a month that you will get as a deduction for a single filer, or $25,000 for joint. Again, this is just for overtime. Same AGI requirements for the overtime as it is for tips. $150,000 for single, $300,000 for joint. But again, to qualify for overtime, again, kind of like the tips, you can't just all of a sudden say, well, I'm working overtime, I want to get a deduction. it needs to be what is qualified time spent. You need to be an hourly worker that basically is working more than 40 hours basically in a standard work week, and then you could essentially qualify. So look, some of you may or may not, qualify for overtimes or tips. As the investment professional on the team, one of the things to kind of think about is like, well, why are we doing this? It's because we are still looking for qualified people to fulfill a lot of service sector jobs in our economy that basically require overtime or tip oriented type stuff. So it's positive for restaurant stocks and things like that we invest in, because it basically is going to increase the demand for those job spots. So, that's how we're kind of looking at it. Clearly today we're articulating it to you to see if, you or a loved one basically sort of fits within here, and how you can sort of help them better understand some of the new updated rules. But even just from an investment perspective, I think it's very interesting for our economy to legitimize maybe some of this money that's not necessarily being claimed, and to increase the demand for some of these different professions.
So Sloan, do you have anything else for us?
I think that wraps up everything that was important about the new bill.
All right. Again, like we said earlier, a lot of this new legislation is still kind of fluid. There isn't certain things still need to be determined as far as how the details are going to work. One of the things we like to do as a team is work in conjunction with our clients' accountants and CPAs to help them strategize and maximize what is available to them as it pertains to their specific situation. The other thing we can do for clients, if they're interested, is come tax time, we're more than happy to send all of their tax documents that we have access to directly to their CPA with their permission. So if you're interested in that, let us know. And again, as this legislation continues to evolve, and as we progress into the end of the year, if you feel it would be beneficial to get on a call with you and your CPA, let us know. We'd be happy to do that. Michael, Jeff, do you guys have anything else you want to add?
I think we covered most of it.
Yeah, no, look, obviously we're always here. As things develop, we'll continue to keep you in the loop. And if you have any more detailed questions, please reach out. Thank you for your time.
Thank you, everybody, and enjoy the rest of your summer.
Thank you.
Yeah.
Thank you.